Welcome to The Explainer. Today, we're diving into a really provocative perspective from economics commentator Mark Tilbury. He brings up a seriously bold premise. You know those financial struggles younger generations are facing right now? Well, according to his source material, they aren't just bad luck. And no, it's not because you're spending too much money on avocado toast. Tilbury argues that what we're actually living through is an economic heist.
The absolute core of his argument is right here. An entire generation has had their financial future stolen from them. Tilbury, who actually points out that he grew up during the golden run of the baby boomer era, frames our modern economy like a totally rigged game of Monopoly. I mean, imagine sitting down for a game night, right? But one player gets to take 2 full trips around the board, buying up all the prime property, collecting rent, way before you even get to roll the dice. And then they act shocked when they win. He's arguing that basically, halfway through the game of life, the rules were quietly rewritten to favor the people who were already on the board.
To really grasp this so-called heist, we have to look back. The source describes the 1960s and 70s as playing the economy on literal easy mode. We're talking about the golden run. Back then, college tuition was something you could actually cover with a basic summer job. Corporate gigs came with ironclad pensions, and you could comfortably support a whole family on just a single income. Now contrast that with the hard mode reality young people are facing today. We're talking astronomically expensive housing, wages that barely budge against inflation, and just crushing student debt. The case he makes is that boomers didn't just casually live through a good economy, they were essentially handed the strongest economy any country has ever built. So that brings us to a massive pivot point in our timeline. I want you to ask yourself a question, and it's a big one. What does an economy actually reward? According to the source material, the answer to this completely flipped right around the year 1980. And honestly, the wildest part about this whole thing, almost nobody even noticed it happening at the time.
And this is the absolute crux of Tilbury's whole argument. Before 1980, the economy primarily rewarded earning. You worked hard, provided value, and your wages were your main ticket to a good life. But after 1980, the system shifted drastically to reward owning. It was no longer strictly about the physical work you put in. Wealth became entirely about the assets you held, things like property and stocks. Basically, we transitioned from an earner's economy straight into an owner's economy. So how exactly did that happen? Well, the source points to 5 specific systemic rule changes that fueled this massive transition. First, taxes tilted to heavily favor capital gains. That meant a dollar you earned just from owning shares was taxed a lot more gently than a dollar you earned through actual physical labor. Meanwhile, unions started fading, which stripped average workers of the real power to push their wages up. On top of that, you had factories moving overseas to cut costs. Sure, it boosted corporate profits, but it absolutely gutted working towns. Then, Wall Street guardrails were removed, allowing these massive fortunes to be made just by shuffling money around. And finally, the whole corporate mission shifted entirely to maximizing shareholder value. In practice, that just meant squeezing worker wages to make sure the stock price kept climbing. The result of all those shifts? It was like pouring rocket fuel on asset prices. Take the S&P 500 index, for example, which tracks America's biggest companies. Back in 1980, it was sitting at under 150 points. Today, it's pushing past 7,400. To put that in perspective, the market climbed more than 180 times inside a single working lifetime. If you spent those 40 decades just earning, well, your paycheck barely moved compared to the cost of living. But if you spent those 40 years owning, you literally got richer in your sleep.
So who actually captured all these incredible gains? The demographic breakdown is pretty stark. Baby boomers make up about 20% of the population, but they own roughly 50% of all U.S. household wealth. We're talking somewhere north of $80 trillion. Millennials, who represent a very similar slice of the population, hold only about 10%. The gains from this huge asset explosion, they didn't just shower down equally on everyone. They landed squarely in the laps of those who are already positioned as owners. And the invisible engine keeping this wealth gap constantly expanding without anyone even having to lift a finger is compound interest. The source highlights a really crucial dynamic here. Assets buy more assets. Think about it. If you have a paid-off home, it acts as a financial launchpad. You can borrow against it to buy a rental property. The rent from that buys dividend stocks. The dividends buy more shares. It just multiplies. A wage, on the other hand, pays for rent and food, and whatever tiny bit is left over just sits there. Your wage doesn't go out and earn another wage while you sleep. You're basically just treading water.
You can actually see this physical lock-in effect super clearly in the housing market. Empty nest boomers, so households with just one or two older adults and no kids living there, they own 28% of large family homes in America. Millennial families, the ones actually raising children who desperately need those extra bedrooms, they own just 16%. And the source points out something crazy. Nearly 58% of those boomer homeowners don't even have a mortgage. They have absolutely zero financial incentive to ever sell. This jams up the entire housing ladder and pushes the average age of a first-time buyer all the way to 40. Now, you might be wondering, why doesn't the system just naturally correct itself? Well, according to the source, when money accumulates in large enough amounts, it actually stops being just money. It turns into political power. Older populations vote very reliably, and political leadership already skews older, so politicians naturally cater to them. This results in rules and policies that meticulously protect asset owners. We're talking about things like aggressively low interest rates or bailouts whenever the markets get a little shaky. Essentially, the system works overtime to prop up the assets held by older generations, and it's heavily subsidized by taxes like Social Security and Medicare, paid for by the younger workers who are entirely priced out. Of course, we've all heard the famous cover story used to explain away this whole lopsided system, right? Stop buying avocado toast, cancel your streaming subscriptions, pull yourself up by your bootstraps. The source notes that this narrative is incredibly effective, mostly because it conveniently points the blame directly at the individual daily habits of young people, rather than looking at the massive systemic rule changes that actually altered our economy. So the crucial point the explainer makes here is this. Yes, building good financial habits and saving your money are absolutely necessary just to get in the game. But saving alone? In today's economy, it's mathematically insufficient. The source explains that you simply cannot budget your way out of a system where the target you're aiming for, like housing or stocks, is sprinting away 6 times faster than your income is actually growing. The lie wasn't that saving works. The lie was telling people that saving is all it takes, while existing asset owners are just minting fortunes in the background. At this point, you're probably asking, okay, but what about the great wealth transfer? We constantly hear that when the older generation passes on, trillions of dollars will just organically flow down to younger people and magically fix the imbalance. So, will this save us? The source pivots to analyze this highly anticipated event and frankly concludes that, for the average person, it's mostly a fairy tale. Let's break down exactly why this transfer myth completely falls apart. First off, staggering end-of-life healthcare costs can easily swallow up entire fortunes before they're ever handed down. Second, the wealth that actually does survive, it mostly transfers strictly within families that are already wealthy. It moves from comfortable parents to comfortable kids. It is definitely not reaching the young person currently drowning in rent with zero financial backing. Because of this, the wealth transfer actually hardens the generational wealth gap rather than closing it. And this brings us to a really important nuance from the source material. It wasn't like every single baby boomer got incredibly rich. While boomers as a whole are definitely the richest generation in history, look at the concentration within that group. The top 10% of boomers hold a staggering 71% of all boomer wealth. They own 93% of all the shares in the country. It's a tiny elite right at the top that didn't just ride the system, they engineered it and they own it outright. The average boomer just benefited from playing the game on easy mode, getting a cheap house and a steady pension. Okay, I know that is a pretty heavy reality check on our economic setup. But let's shift gears for a second, because the source material actually takes a surprisingly optimistic turn here when looking at the future of younger generations. There's this old historical cycle: hard times create strong people. And because the economic game is so brutally difficult right now, young people are adapting. They're highly focused, they're up at midnight learning complex skills online, they're drinking less, and they are becoming incredibly resilient. According to the source, younger people today are the strong generation, actively being forged by these hard times. So how do you actually navigate a system that feels this rigged? Well, if the system punishes earners and rewards owners, you literally have to cross the bridge from being just an earner to becoming an owner. The source gives 3 actionable steps to make this happen. Step 1, you have to learn the real rules of the game. Educate yourself on how money, investing, debt, and taxes actually function in the real world. Step 2, learn AI. You need it to gain a massive leverage and business advantage over everyone who's just ignoring it. And step 3, focus relentlessly on learning high-leverage digital skills. We're talking about skills that allow you to reach thousands of people at once or automate complex tasks, basically making a business money or saving it time. According to the source, this creates the ultimate modern playbook for building wealth. You don't try to patiently save your way to riches from a stagnant paycheck. That doesn't work anymore. Instead, you use those newly acquired digital skills to absolutely maximize your earning power.
Then you aggressively take those earnings and use them to buy assets, stocks, businesses, real estate, whatever it is. Because at the end of the day, those assets are what eventually grant you true ownership and real financial control over your life.
We've definitely covered a lot of ground today, unpacking how an economy designed for earners quietly transformed into an economy massively stacked in favor of owners. It's a tough system, right? The asset you're chasing is sprinting away from your paycheck. But building wealth today isn't impossible. It just requires a totally different rule book. So the final thought the source leaves us with is this. The question isn't just what the system did to your financial starting line. The real question is, now that you can clearly see the real rules of the game, how are you going to play it?